Hello and welcome to Livewire. My name's Tom Richardson and today I'm sitting down with Teiki Benveniste, the Managing Director for Australia and New Zealand of AWMS Wealth Management Solutions. Teiki, welcome.
Thanks, Tom.
So everyone's talking about investing in alternatives. What's behind the rising interest in private markets?
It's interesting because it's been happening for many years now, but if you look at listed equities in the US, the number of companies that are listed is steadily coming down. From about 8,000 in the late 90s to just below 5,000 now. So less and less companies in the listed space. And then when you look at the private space, basically companies are staying private for longer. So that creates really an attractive opportunity for capital, private capital to invest into those companies. You've got around, if you think about the middle market companies in the US, which is companies generating between $10 million to $1 billion of cash flows, you're talking about 200,000 companies, and 99% of those companies are private. So it's a very large opportunity set. I think the second thing is that not only is it a large opportunity set, it's also a fast-growing opportunity set. So if you look at the last 5 years, in terms of revenue growth, those companies in the middle market would have had about 60% cumulative revenue growth over the last 5 years. So that's quite attractive. They tend to have growth higher than listed companies as well. So all of those things combine, a large opportunity set, attractive growth characteristics, being a significant part of the economy. In the US, it's about a third of the private GDP of the US. All of those things mean that there is interest from capital to be backing those companies, to be investing in those companies for growth.
And are there other benefits in private markets versus public markets for investors in terms of helping them diversify?
Yeah, so I think if you look at the two sides of the same coin, which are private credit and private equity, if you're a private equity investor in a middle market company, then you're in it for capital growth. If you're a private credit investor in a middle market company, then you're in it maybe for income. But you have that access on both sides. And when you look at the history of private credit, for example, so the benefits for investor have been compared to public or liquid markets that are similar. It's a consistent yield premium. So you get excess yield over a comparable liquid instruments. When you look at private equity over listed equity, you see that the private equity has outperformed listed equity significantly over the last 20 years. So you start with that, and you're looking at the potential for larger returns or higher returns in those markets. And then on the risk side, both those asset classes are exhibiting attractive, lower volatility profiles than more liquid instruments. So of course you're giving up liquidity because these are not liquid instruments, but you also are reducing potentially volatility in your portfolios when you add that to a diversified portfolio.
How can investors identify the best private markets opportunities, and how does AWMS stand out?
I think we're strong believers that in private markets, scale is your friend. And you can take the metaphor, if you want, of a funnel. If you build a very large funnel in an environment where those companies, you can't pick up the phone and buy their stock, or you can't buy their bonds. It's not there, it's not listed. You have to go and find them. So you need to build the infrastructure to be able to go and find those companies, to find the best opportunities, and then be incredibly selective about the ones you actually back. And then, so that's the infrastructure that you need to build, which is scale. And then it's how you use the scale. And we believe that sharing the information across the different parts of our business, at AWMS we manage today over $500 billion of alternative assets across multiple verticals: private credit, private equity, secondaries, infrastructure, real estate. And all the information, all the contact points, all the sourcing points that we have across all of those businesses, we believe that we need to share the information. We need to share the information to make better informed decisions and to generate better outcome for investors. So really scale and the sharing of information would be the two main things that we would flag as a way for us to outperform in those markets.
And how does Ares offer Australian investors access to opportunities in private markets?
It's an interesting one because over the last 5-10 years, I think the access or the democratization of access for private wealth investors to private markets is really improved. You have seen the rise of semi-liquid funds that allow private wealth investors to invest and access those markets in probably a more efficient way than the closed-ended capital call structures. Generally giving them a better experience in our mind. So really, when you look at the two asset classes we really talked about today, on one side, we're able to offer access to the full breadth of the Ares platform, right, across all the credit or private credit instruments that we self-originate, such as US and European direct lending, alternative credit, which is asset-backed direct lending, credit opportunities, and really in one swoop you get access to that broad platform and the benefits that we've talked about of higher yield and lower volatility compared to comparable liquid markets. And then on the private equity side, we really are excited about the opportunity in it's often talked about as an asset class, but really it's not an asset class. It's an access point, which is secondaries, private equity secondaries. You get access to private equity via secondaries. Really, it's how you think about that. And when you put that into a semi-liquid structure, we believe that it's a great diversified way to access this private equity space with over 7,000 issuers. Broadly diversified, that's generally invested in assets that are in the harvesting phase, so you already have a natural return of capital and cash flow coming back. So when you combine those two in a portfolio, what we believe is that it allows you to increase your potential return profiles and decrease volatility. So we believe that's quite exciting for investors.
Teiki, that was terrific. Thank you very much. If you like that video, please visit livewiremarkets.com and subscribe to our YouTube channel.